All right, welcome. Today we're going to tackle a really core concept in Canadian corporate tax, the Section 85 rollover. More specifically, we're going to get into the nitty-gritty of how to calculate the adjusted cost base and the paid-up capital for shares you get in one of these transfers. So let's dive in. So you might be asking yourself, why do we even have a special rule like Section 85? Well, to really understand its power, you first have to appreciate the big problem it was created to solve. Imagine this. You own a valuable asset. Maybe it's a piece of land or some crucial equipment, and you want to move it into a corporation that you control. Well, the default tax rule says, hold on a second. That transfer is considered a sale, or what the Act calls a disposition. And what does that mean? It means you could be hit with an immediate and potentially huge tax bill on any built-up capital gains, even though not a single dollar of cash has actually changed hands. That's the fundamental problem. And that's where Section 85 comes riding to the rescue. It's the solution provided by Canada's Income Tax Act. Its whole purpose is to allow you to transfer that asset into your corporation on a tax-deferred basis. This is an absolutely essential tool for organizing a business because it means you don't have to come up with cash to pay a big tax bill right at the start. Here's our game plan for today. We'll start by breaking down the two key calculations you have to get right, the adjusted cost base, or ACB, and the related but very different concept of paid-up capital, or PUC. After that, we'll roll up our sleeves and apply that knowledge to 3 practical case studies. And finally, we'll zoom out and talk about why getting these details right is just so critical for any kind of effective tax planning. Let's kick things off with our first big calculation, the adjusted cost base. See, when you do a Section 85 transfer, you're getting shares in the company in return. The ACB of those new shares is basically your tax cost, and that number is going to be incredibly important down the road when you eventually sell those shares and need to figure out your capital gain. Now, it is absolutely crucial that you don't mix these two terms up. ACB is a pure tax concept. It's your cost for figuring out future capital gains. PUC, on the other hand, comes from the world of corporate law. It represents the capital that can be given back to a shareholder tax-free. They really do come from different legal universes, but as we're about to see, the tax rules in Section 85 force them to align. The good news is, calculating the ACB of the shares you get follows a very clear 3-step waterfall. You start at the top with the elected amount. That's the value you and the corporation formally agree on for the transfer. First, you have to allocate that value to any non-share consideration, what we call BOOT, think cash or debt. Whatever's left over then flows down to any preferred shares you received, up to their fair market value. Any final residual amount that's left at the very bottom becomes the ACB of your common shares. Okay, let's put some numbers to this to make it real. In this example, the elected amount is $620,000. We subtract the BOOT of $325,000, which leaves $295,000 to be allocated to the shares. Now, this $295,000 is the total ACB for all the shares. Following our waterfall, we allocate the first $225,000 to the preferred shares, matching their fair market value. The remaining $70,000 then flows right down to the common shares. Okay, now we move on to paid-up capital. While the ACB calculation is a pretty clean waterfall, PUC presents us with a bit of a puzzle. You see, under corporate law, the initial PUC of new shares is based on their fair market value, and this creates a potential tax loophole that the Tax Act simply has to address. Here's the problem. In our example, the shares issued have a fair market value of $489,000. If the PUC were allowed to stay at this high value, the shareholder could potentially withdraw that entire amount from the corporation tax-free. But wait a second. Their tax cost, the ACB, is only $295,000. This would let them get that deferred gain out without ever being taxed, which completely undermines the whole point of the rollover. So, to prevent this, the Income Tax Act steps in and requires a specific PUC reduction. The goal is to grind down that initial legal PUC to make sure that the deferred gain stays trapped inside the shares, ready to be taxed when they're finally sold one day. The formula for this reduction is often expressed as A minus B. So let's break that down. Component A is simply the total increase in the corporation's legal stated capital. In our context, that's just the fair market value of the new shares that were issued. Now, component B should look very familiar. It's the elected transfer price minus any BOOT received. This is the exact same calculation we just used to determine the total adjusted cost base of the shares. So you can just think of component B as being the total ACB. So let's put it all together using our example. Component A, the fair market value of the shares is $489,000. Component B, the total ECB of those same shares is $295,000. The difference, A minus B, gives us a required total PUC reduction of $194,000. So here's the key takeaway. After that reduction, the final total PUC of the shares will be $295,000, which perfectly matches their total ACB. This alignment is the entire point of the exercise. It ensures that the shareholder cannot pull more value from the corporation tax-free than their original tax-deferred cost. Now that we have the mechanics for both ACB and PUC down, let's apply them to 3 distinct cases. We'll look at different types of assets, first depreciable property, then inventory, and finally land. In our first case, we're dealing with depreciable property. Now, a critical step in any Section 85 plan is to figure out the allowed range for your elected amount. The ceiling is always the fair market value, the floor is the greater of the boot received and the asset's undepreciated capital cost, or UCC. Here, the boot of $140,000 is higher than the UCC, so it sets our minimum elected amount. Now, electing at the minimum value of $140,000 doesn't mean there are 0 immediate tax consequences. In this case, because the elected amount is above the asset's original cost and its UCC, it actually triggers both a recapture of previously claimed depreciation and a small capital gain. So remember, a rollover is a deferral, not always a complete elimination of tax right away. So let's calculate the ACB for the shares received here. We start with our elected amount of $140,000 and we subtract the boot, which is also $140,000. That leaves us with 0. The total ACB of the shares is 0. And applying the rules we just learned, the PUC must also be grounded down to match, resulting in a final PUC of 0 as well. Our second case, with inventory, follows a very similar logic. The elected range is set between the boot and the fair market value. Electing at the minimum of $93,000 still triggers a gain. The key difference here is the type of gain. Because it's inventory, the profit is treated as business income, not a capital gain. But just like our last example, because the elected amount equals the boot, the final ACB and PUC for the shares are both 0. Finally, let's look at a transfer of land. Here, the minimum elected amount is the cost of the land, $617,000. We subtract the boot of $72,000, which gives us a final ACB for the shares of $545,000. For the PUC, we start with the fair market value of the shares, $751,000. The required reduction is the difference between that starting PUC and the final ACB, which is $206,000. The result? A final PUC of $545,000, perfectly matching the ACB once again. So, after walking through all those detailed mechanics, why does this level of precision matter so much? What's the big picture for you or your clients? The integrity of the entire tax deferral system really rests on these rules. The ACB calculation correctly establishes the cost base for the future, and the PUC reduction mechanism, well, that acts as a critical backstop. It ensures that the value of the deferred gain cannot be stripped out of the corporation tax-free. It ensures you can't escape the tax on any accrued gain. And this brings us to a final thought. This intricate dance between ACB and PUC in a Section 85 rollover is a perfect example of a fundamental tension in tax policy. The question it forces us to ask is, how can a tax system effectively balance the goal of enabling commerce through deferrals while simultaneously maintaining a framework to ensure every dollar of economic gain is ultimately taxed? The answer lies in the detailed rules we've just explored. Thanks for watching.